This is my main point. The economic mechanism of the Eurozone, not the political mechanism, which we can talk about, but speaking strictly about the economic mechanism of the Eurozone, is fatally flawed. And the reason I talk about it related to Brexit is that I think clearly there will come a time when the EU will be in crisis again, almost certainly, and that'll be 6 months or a year or 5 years down the road. And whatever you might think about Brexit now, people will look at the UK and think, boy, aren't they smart for being not involved in this giant mess that's happening. And so let's just talk about, I say it's fatally flawed. Let me explain why. Please subscribe and also hit the bell so you can be notified when I make a new comment. This is not financial advice, it is just commentary and analysis. The UK is officially out of the EU, and that means we're in a transition period that will end December 31st, 2020. Some think that's great, some think it's terrible. What I think personally is that I don't think it'll be the economic calamity that many of the Remain-oriented politicians expected, but the economy is just one part of that decision. As one UK market professional said, there are some things more important than money. So beyond the economic impact, I think reasonable people can disagree, but Brexit has already happened now. I don't want to dissect all the arguments for and against. Let's look towards the future. The EU has an incentive to make this process as difficult as they can for the UK. They don't want the voters of other countries to get any ideas. If they had their way, they would make this be extremely tough on the UK, and assuming they could isolate themselves in some way. So let's look for just a minute at how large the UK is relative to Europe. So if you look at this graph I have on the screen now, you'll see that the big four economies in what the way the EU was constituted are France, Germany, of course, is the largest, Italy, and the UK. The UK being the second or third largest. This graphic shows a little bit in a more interesting way, but look at the UK. The UK is one of the major economies in the EU, so them leaving is definitely not great. Remember a while back, around 2012, when we were wondering if Greece would leave the Eurozone and the EU? Here's what that looked like. This graph is ending around 2015, but just to give you an idea of what the world looked like at that time. Okay, in this graph, we see Greek GDP relative to a handful of other countries in the EU. And you can see that Greece is a huge outlier, right? So GDP at its low point was 25+% down. And so that just tells you what kind of horrific experience was happening in Greece. And this graph is GDP. Let's look at unemployment. This is also from around the same time, but you can see the area with the biggest problem in unemployment at the very top of the list is Greece. And look at the bottom of the list. The bottom of the list has Germany. Okay, so obviously Germany's economic powerhouse, the most competitive in the EU, huge exporter, big manufacturing base. But here's the question. In the under 25 category, Greece had an over 50% unemployment, over 50% unemployment for people under 25. In Germany at the same time, it was 7.5%. Okay, so we see massive unemployment in Greece, and we see very low unemployment in Germany. So my question to you is, why didn't those Greek people who were unemployed and looking for work move to Germany and get work? So this is my main point. The economic mechanism of the Eurozone, not the political mechanism, which we can talk about, but speaking strictly about the economic mechanism of the Eurozone, is fatally flawed. And the reason I talk about it related to Brexit is that I think clearly there will come a time when the EU will be in crisis again, almost certainly, and that'll be 6 months or a year or 5 years down the road. And whatever you might think about Brexit now, people will look at the UK and think, boy, aren't they smart for being not involved in this giant mess that's happening. And so let's just talk about, I say it's fatally flawed. Let me explain why. And let's look beyond what's right in front of our faces and just look down the road a little bit. Okay, so in the US, we have the Federal Reserve. The Federal Reserve attempts to manage the economy by influencing interest rates and more recently by changing the composition of its balance sheet, where they'll buy government bonds and maybe other things in the future. And the reason that this generally works, leaving aside as to whether I think this is a good idea or not, that we have a system that works this way, right? All the major economies basically have a similar system at the moment. The reason why it generally works, that we can use one interest rate to manage an economy the size of the United States, is because if someone needs a job in Florida and can't find a job in Florida, but there's an opportunity to move halfway across the country and find work and relocate his or her family in order to have a job, most people will do that. Okay, so even though in the US, we, just like in Europe and just like every other large geographic areas, we have localized economies. Okay, we've got some tech-centric in Silicon Valley, we've got auto-centric in Detroit, we've got mining-centric in certain areas. So even though we still do have these distinct little economies, because we have a labor mobility benefit, that we have a population that is willing to move, that is a major necessity to try to manage one large economy with one interest rate. So let's look at what they do in Europe. They have the ECB, just like we have the Fed. They have the ECB, and they've got a large geographic area. The size of the complete EU economy is roughly similar to the size of the US. And so they try to manage those economies with one interest rate. But the problem is that they don't have the same labor mobility that we have in the US. If someone's in Greece and they don't have a job, they are much less likely to go move to Germany, where unemployment is very low. And so that means that you have these different economies that require different interest rates in order to give an optimal outcome, and you will never be able to do it from the EU. You'll always have money that's probably too loose for Germany, and even if the ECB generally is running a very, very accommodative policy, it will probably still be too tight for the least competitive countries like Greece, for example. So when we were talking about Greece, I just showed you Greece. Let's look at what might be the big problem coming up, which is Italy. Back in 2012, before Draghi did the whatever it takes speech, there was concern about Italy leaving the EU, and that has not reached a fever pitch yet, but I suspect at some point it might. And let's just look at what that will look like, because in the UK never gave up the pound. Okay, so you still had the UK banking system, which is very large. The UK is the banking capital of Europe. Okay, it's the capital markets center of Europe. Just like New York is for the US, London is for the UK. There are obviously lots of large banks in Paris and Frankfurt and in Italy, but the UK is really the center. I'm just going to pull up two articles to just talk about some of these ideas. And both of these articles are from 2019. So they're not totally current, but they're not from that long ago. First, I just want to touch on an article written by the Brookings Institution, and leaving aside whatever you think about them, it doesn't really matter in terms of whatever political bias you might think about them or not. This is just talking about some of the mechanics that will need to be considered if Italy starts considering leaving the euro. The rise of strong Eurosceptic parties in Italy in recent years has raised serious concerns about whether the country will permanently remain in the euro area. Although anti-euro rhetoric is now more muted, the fear of an Ital exit still lingers in the economy. Italy's notoriously high public debt is generally considered sustainable and not at risk of defaulting. However, investors see political unknowns still weighing on the financial stability of the country. Mirroring uncertainty, the Italian long-term government bonds carry interest rates that, though historically low, are 4 times higher than their Spanish or Portuguese equivalent. So you can see that there's already a premium being built in, that the financial markets view Italy being a bit more risky than other countries. And in the back of their minds is I'm sure that if a politician sees that it's beneficial for that politician to say, elect me and I'm going to take us out of the euro, okay? That's all that's necessary. At some point, some politician sees the political wind changing and sees that the voters in Italy don't want to be part of this anymore. And they say, vote for me and I'm going to get us out of this. And then the financial world starts to deconstruct how the myriad of issues this brings up. Okay, so back to the Brookings article, it says currently Eurosceptic parties are clearly leading Italy's polls. Jumping down, the document, a particular document that was put together in 2012 that talked about all the disastrous problems that would happen. The document should discourage once and for all Salvini's openly anti-Euro advisors from implementing their reckless Ital exit plan. I don't want to talk specifically about who's saying what in Italy right now. The point is, at some point, it's highly likely that a politician will see it in his or her interest to say, vote for me and we'll leave the euro. And if that politician is reading what the voters want correctly, then this can of worms is going to be open. Some months later, the group published, this is back in 2012, some months later, the group produced an 11-page document that was called Plan Z in order to spell out the implications of Italy's extreme option. The study considered the eventuality of a crisis of confidence in the euro area that would move depositors to withdraw their funds from Italian banks, okay, so bank run first. Italian authorities would then be forced to introduce administrative controls limiting cash withdrawals, okay, so capital controls, as well as close cross-border money transfers. Those measures, though inevitable, would have aggravated panic among the public, I'll say, and it can't always be completely, it's usually not effectively done. So money still gets out, you have a full-on banking crisis, and then the banking crisis, because the banks and the country's government are so intertwined, turns into a sovereign debt crisis for the country. Back to the article, the consequence would have been Italy's default on its public debt. The Plan Z document mentions a severe recessionary impact on the economy, although one that would have been hard to estimate up front. Initially, the exchange rate would be fixed at 1 euro lira for 1 euro. Later, the market would force the euro lira to devalue in an unpredictable measure. So they say, hey, Italy says, we know that we owe you, France, 285 billion euros, the banking system in France, but instead of paying you euros, we're going to make these new euro lira, and instead of paying you euros, we're going to pay you euro lira, and everyone knows that the reason they make that change is because that euro lira, as soon as it starts trading, will be devalued. So they're basically saying, we're going to default, but we're not saying we're not going to pay you. We're going to pay you these euro lira instead of the euro, and we all know that those are going to be worth much less, although we can't tell you exactly how much less they're going to be worth. The most dramatic consequence of Ital exit would have been the constant litigation over every single measure undertaken by the government. A long technical annex to the document describes a daunting scenario of legal controversies lasting years that would have made the whole operation completely unrealistic and doomed to catastrophic consequences that would have reverberated even beyond the euro area. So this is the thing. Every little step, every time you scratch the surface, you open up this enormous can of worms that's going to be problems that will last indefinitely in the future. The litigation that would go on would last for decades probably. I mean, we can see that that a big hedge fund like Elliott it takes huge positions in defaulted government debt and then goes and chases those governments down for years and decades. In this case, you will not just have some big smart hedge funds who are going to be very litigious. You're going to have litigation from all angles, from different sovereigns, from banking systems, etc. The article points out that there are two versions of the document, and around the time this document was produced is when Draghi made this whatever it takes speech. And so basically, we don't know what kind of behind the scenes political issues this was causing. But the response to this in the past has been this. This is critical to understanding what's happening in Europe right now. The response to this in the past has been that the European Central Bank just shows up and buys an enormous amount of debt from all these countries. Sovereign debt, banking debt, they are basically just papering over this whole problem. So even earlier in this article where they said, well, Italian debt trades at a bit of a premium versus the other countries, that's even with the European Central Bank trying to keep everything calm. If the European Bank stepped away, it would take very little for one of these countries to have a crisis. Just a few other points to make from DW.com talks a little bit about that also. They call it a doom loop. DW is like Germany's version of the BBC, basically. And I don't think it matters for this particular article, but their political leaning is probably center-left. Okay, so they talk about a terrifying story spooking the Eurocrats in 2019, and that comes from Italy. Most governments around the world owe a fortune, but the Italian debt pile would make most others blush. Italy owes $2.3 trillion, a little over 2 trillion euros in public debt. That's about 133% of GDP, a massive ratio that puts it among the top 5 in the world. So as a country, it's big. It's the third largest in the Eurozone and one of the top 10 worldwide. And it has high debt on top of it. And a lot of that borrowing is owned by banks in Rome and Milan, Italian banks. European banks also are very exposed to anything going wrong. And so take a look at this graph from Bloomberg. It points out that France is in the hole for potentially 285 billion euros, according to a study by Bloomberg, while German, Spanish, British, and Belgian banks also have cause for concern. So remember what we just talked about. If all you would need is for a Eurosceptic politician to start gaining considerably in the polls and for people to start believing that the population of Italy is going to vote for a Eurosceptic government, and then everyone is instantly going to jump to this analysis. Okay, if they do that, and if Italy tries to leave, they're going to try to pay back all their debt in some new currency, not euros, because they've got long-dated debt, and they'll have a new euro lira, let's call it, and so that means when they pay off the debt that they owe, it's going to be in euro lira, and that is going to be worth much less than a euro, and therefore anyone who owns those bonds are going to lose money. The article further calls it a doom loop, which I think is fair. The extent to which European banks are tied to Italian debt levels, it's much stronger than it might otherwise be, given the size of Italy. Were Italy to try to leave the Eurozone in the coming years, there could only ever be a disorderly departure, if such a departure were even possible. Although still very much an extreme hypothetical scenario, a disorderly euro exit would increase the possibility of Italy defaulting on billions of euro debt. And for perspective, from that rises the specter of what would be the largest default in economic history. If the population in Italy starts to feel like they want to be out of the EU and gets behind a politician that says, vote for me, I'll do this, the financial markets, even before that person is elected, will start to worry about and price in the largest default in economic history, and it'll be from one of the main EU players, and it will mostly affect the other EU countries. It'll be an enormous mess. If you have one scenario that is, even though it's hypothetical, but that it's extreme and very bad, okay, then you only need to have the probability of that thing happening go up slightly in order for financial markets to start to have chaos. Okay, so if people think that thing has a 2% chance and that goes up to 10%, that is going to have a big impact on prices. Now, like I said, in the past, what's happened is that the European Central Bank comes in and cleans up all the debt. So the European Central Bank is holding it together, but it is still to be seen what happens when the voters of a country, and Italy is one of the few major economies in the Eurozone, that if the voters push to leave, then that is going to be extremely chaotic. I don't know exactly how it will play out. It will certainly be bad. No one knows exactly how it will play out. You don't know exactly how it'll play out. Lagarde doesn't know how it'll play out. Angela Merkel doesn't know how it'll play out. It'll be very bad. And to come back to the point about Brexit, because it'll certainly cost people, it'll certainly cost countries money, right? And once the German voters wake up to be realizing that, hey, the ECB is papering over all these problems, somehow that's going to come back to me, the taxpayer. Okay, so I think, I've always thought, and I haven't been right so far, but I've always thought there's some reasonable likelihood along the way that the German voters say they want out, right? If they start to see that this thing is costing them a lot of money and ultimately the German taxpayers are going to be footing the bill, then that might create a risk that the German voters start voting for someone that says, hey, vote for me, and I'm going to pull us out of the EU. So in all of those scenarios, in some certain number of years from now, we'll be looking at the UK and thinking, boy, aren't they smart to not be involved in this giant mess. That's it. Thanks for watching. Don't forget to hit the subscribe button and hit the bell next to it also. Thanks.